According to figures published in consumer magazine Which, to retire today and maintain a moderate lifestyle, a single person would require approximately £31,000 worth of income per year, or £43,100 if in a couple. However, a committee of MPs from the previous government that were looking into pensions found that more than 60% of people are at risk of not having an adequate standard of living at retirement. This is despite the introduction of automatic enrolment, which has increased the number of people saving for retirement through workplace pensions, but still leaves a significant gap. Experts reckon that people should be saving at least 12% of their salary into a pension, but that lots of us are falling short. And people over the age of 40 who have less time to save for retirement are particularly at risk. Many reasons are cited for why people consistently fail to adequately prepare for retirement, from the affordability of monthly saving deposits to economic uncertainty that puts people off investing. But one of the single biggest factors contributing to the problem is financial literacy. A recent article in the Financial Times reveals how half of adults need urgent help in managing their finances, and how the UK fares pretty poorly on financial literacy rates when compared to other developed countries, with the OECD ranking the UK 15th out of 30 developed nations, well below the likes of France, Norway and Austria. Numerous studies also linked low levels of financial education with high levels of economic deprivation. It therefore makes sense for us all to have a better understanding of finances to potentially create better future financial outcomes for us all. So if you want to invest, but are cautious or just don't know where to begin, this video will hopefully help set some basic foundations for you and encourage you to get going and start building your wealth for the future. In this video we will cover why cash savings are not a good idea for long-term wealth building, what compounding is and the fantastic compounding opportunities you get from investing, workplace pensions, choosing an online platform to hold your accounts and investments, what types of investment accounts to use, and which investments to choose to put in these accounts. Before we start, I need to tell you that I'm not your financial advisor, and this video is for education purposes only and not to be construed as financial advice. Fact check anything that anyone tells you on YouTube, including what I say here. Do your own research to ensure that any choices you make fit your personal circumstances. Please seek the advice from a suitably qualified financial professional if unsure of anything. And your capital is at risk from investing, and you may end up getting less back than you put in. Investing is an act of allocating resources, usually money, with the expectation of generating an income, profit or financial gains for you to spend in the future. The underlying problem with this is that in the future everything will be more expensive because of inflation and the cost of living consequently rising. If we take a shopping basket containing a 2-pint bottle of milk, half a dozen eggs, a loaf of bread and 2 bottles of beer, with a basket costing approximately £10. If you were to save that £10 and stash it under a mattress rather than using it to pay for those goods, and then to bring it out after 10 years, you will find that this £10 would not be able to afford all those goods that were in that original basket, and you will probably have to kiss goodbye to that alcohol at the very least. The cost of living would have risen, with everyday items costing more, and that £10 would have lost purchasing power. To plan for the future, we therefore need to work out a way of making that £10 grow into something larger to keep pace with and possibly try to beat inflation and the cost of living to give us a chance of having a decent retirement. Many people think that putting your cash into savings accounts will achieve this, but they will be wrong and will severely risk their chances of building sufficient wealth this way. Traditional savings accounts typically offer very low rates of interest, which fail to keep pace with the cost of living and inflation. Even higher yielding accounts with better rates of interest may still fall short in the long run. If you have a savings account that's paying 2% interest, but inflation is currently running at 3%, your real purchasing power decreases and the money in your account is losing value in this example, even if on paper the amount of money in your account is increasing. I know that some of you are thinking that interest rates are currently running at 5% in September 2024 and that inflation is much lower, meaning that savings rates are rising above the cost of living. So why do you need to do anything else? But what we are experiencing at present is potentially a short-term, less usual situation, and it is very unlikely that interest rates will continue to outpace inflation in the longer term, if data from the past is anything to go by. According to online site rateinflation.com, UK inflation rates over the past 20 years have averaged 2.5%, whereas average savings rates over the same period have only been a little higher at 3.1%. This means that your average real rate of return over the past 20 years would have been a meagre 0.6% per annum. So if you'd saved that £10 in a savings account rather than stashing it under your mattress for 10 years, with an average savings rate of 3.1% per year, your 10-year annualised return would have been £13.57. That's £3.57 profit. But that £10 would actually only be worth £10.62 when adjusting for the average inflation over that time of 2.5% per year. So in effect, that £10 would only be worth 62 pence more over a period of 10 years. By keeping your money in a cash savings account, you therefore miss out on the potentially higher returns that you would get from stocks and shares. For instance, compare that 0.6% return with the average return of 10% that the S&P 500 has given over a longer period of time. That's 7.5% if adjusted for the 2.5% inflation. Invested in the S&P 500, which is an index of the 500 largest US companies, whilst being riskier than cash savings, offers much better growth potential over the longer term, and you then maximise the chances of having a retirement that you deserve. Savings accounts are probably better for storing cash for the shorter term, such as for emergency funds, rather than for delivering long-term wealth. And we will look at what you might consider investing in rather than saving cash later in this video. The bigger returns that equities provides contribute significantly to the compound effect that is a major factor in growing wealth. The compounding effect relates to the process of where earnings from an investment generate additional earnings over time. This happens, for instance, because the interest on earnings is reinvested, allowing the asset to grow at an accelerated rate. Essentially, it's earning interest on interest. Here's a basic, simple cash savings example to illustrate. So in the first year, you save £1,000 at an annual interest rate of 5%. At the end of the first year, you earn £50 in interest, making your total £1,050. In the second year, you earn interest at the same rates, not just on the initial £1,000, but also on the £50 interest from that first year. So you earn £52.50 in interest, making your total £1,102.50. But this compounding effect can be particularly powerful when it comes to stocks and shares investing, for several more reasons. 1. The higher potential returns. As already stated, stocks and shares generally offer higher potential returns compared to traditional savings accounts or bonds. Number 2, the reinvestment of dividends. Many stocks pay dividends which can be reinvested to purchase more shares. This reinvestment allows you to earn returns on both the original investment and the dividends. 3. Capital gains. Stocks can appreciate in value over time. When you reinvest the gains by buying more shares, you increase the amount of money that you can generate future returns. 4. Long-term growth. The stock market on the whole tends to grow over the longer term despite short-term volatility. This long-term growth can significantly amplify the benefits of compounding, especially if you start investing early and stay invested. The earlier you start investing and the more time that you give it, the longer you have for your investments to compound, to the eventual exponential growth of that wealth in the later years. But don't be disheartened if you are older with less time. It's not too late to start your investing journey, and you can still get good returns from your investments that beat cash savings and inflation. The main thing is that you don't put it off any longer. And if you don't think that you can afford it, then think again, because you can start investing from as little as £25. If you are in employment, then there's a good chance you've been auto-enrolled into your workplace pension scheme. That is, unless you opted out at some stage. If you are enrolled, then you will be paying a proportion of your wages, normally about 5% or more, into your pension scheme, which means that you are already invested in assets such as stocks and shares, and are therefore already benefiting from the effects of compounding. And I would suggest that before you start opening the additional accounts that we talk about in this video, you check to see if you are enrolled or not, and if not, treat it as first priority. Why? Where by law, your employer has to contribute a minimum 3% of the value of your salary to it, so they are effectively giving you free money for nothing. Some employers will even pay in more than that 3% minimum, and may even match whatever you pay in from your salary, so it's worth checking this also. All pensions, whether workplace ones or private pensions, have great tax benefits. If your gross salary is £2,000 a month and you pay 5% into your workplace pension, i.e. £100, then this gets deducted from your gross wages prior to tax being deducted on the remainder. So in this example, you get £20 tax relief and only pay tax on the £1,900 remainder of your gross salary. So paying £100 is therefore only costing you £80 when you take the lower tax deduction into account. And you get those same tax benefits if you pay into a private pension. The only difference from your workplace pension is that the tax is deducted at source in your workplace pension, whereas it's added to your pot as relief in private pensions. If paying £100 into a private pension, the government will top this up with 20%. which would be £25 in this case. So employer contributions and tax relief are two additional compounding effects to help you grow wealth even quicker by using a pension. There's nothing to stop you opening a private pension in addition to a workplace one. Private pensions are often referred to as SIPs, or self-invested personal pensions, and investors often have SIPs in addition to their workplace pension to get more choice and control over what they invest in, as workplace pensions can often be more limited in only offering their own funds. They can also sometimes be a little bit more expensive with higher fund costs. Sometimes they can be a little risk averse in that their default options can forsake higher returns, as they often pick a balance of slightly lower risk investments. And that might not be good for you if you're younger and looking to maximize long-term growth potential with higher risk assets. I'm definitely not saying you should transfer your workplace pension to a SIP, as you'll then miss out on that free money that your employer gives you, but you might consider also paying into a SIP, where you will potentially find lower fees whilst having more choice and control. Before opening a SIP, you'll have to choose an online platform to hold your account. And an online platform is another name for an online stockbroker that will hold your account, where you can then purchase and sell stocks and shares, etc. Although a site that is user-friendly is important, that site's costs should really be a priority. The lower the fees, the less those deductions can impede your returns over the longer term. Investment platforms allow you to open accounts such as SIPs or stocks and shares ISAs. We'll talk about stocks and shares ISAs in a minute, and charge you platform or custody fees for holding your accounts and assets with them. These platform fees are one of two charges that investors encounter and are either levied as a percentage of your assets that you hold on that platform or as a monthly fee. When starting off with your smaller pension pot, those that charge a percentage would potentially be the better option, as a smaller percentage of a smaller amount will potentially be cheaper than paying a monthly fee. There are well-renowned investment platforms that offer SIPs, such as Hargreaves Lansdown, who charge 0.45% platform fees, AJ Bell, who charges 0.25%. Both Vanguard and InvestEngine charge 0.15% custody fees. Opening an account is easy and only takes a few minutes, and you will need certain documentation such as photographic ID, your national insurance number, and proof of address. I've provided a link in the description box below to a site called Boring Money that tells you all you need to know about investment platforms. But if you get it wrong, and don't consequently think that you've made the correct choice of investment platform, you can easily transfer accounts, so don't worry. One limitation of a pension is that you can't access anything in it until age 56. This age is due to rise to age 57 from April 2028, and that age could rise further in the future. And although you get great tax benefits from pensions, with your investments also allowed to grow free of capital gains tax, you still pay your personal rate of income tax on anything above your personal tax allowance on money you draw from your pension at pension age. So you might also consider opening an ISA, which is an individual savings account. Not a cash ISA, which is the same as a savings account but just a tax-free version where you'll have low growth from interest in the longer term, but a stocks and shares ISA, or a lifetime ISA, which is also known as a LISA, through which you can buy and hold investments to help you build long-term wealth. With the stocks and shares ISA, you can invest up to £20,000 in any tax year. That's your ISA allowance. Your investments can then grow tax-free. You can make withdrawals at any time, and any withdrawal you make is also tax-free. Having a stocks and shares ISA in addition to a pension could therefore be a perfect complement for an overall flexible financial plan. If you are under the age of 40, then a lifetime ISA or LISA might also be worth considering. Yes, you are limited in that you can only use it for a first-time house purchase or to make tax-free withdrawals once you reach the age of 60. There is a 25% penalty for any other type of withdrawal. But this is a good type of account to have even if you already own a house, due to one significant advantage that they have over a stocks and shares ISA. And that is that the government will give you 25% on top of what you deposit into one of these accounts. And you can deposit up to £4,000 from your £20,000 ISA allowance in each tax year, up until the age of 50. So you could get £1,000 topped up by the government each tax year that you put in £4,000. There are certain rules, such as that you can't deposit money once you reach the age of 50, but this is still a great vehicle for getting that free money from the government, whether you're using it for a first house purchase or as a retirement pot. And you are getting fantastic returns by taking very little risk just by depositing money into this account, with that government money being a great additional compounding factor to help you build wealth for the long term. You're more restricted for choice if wanting to open a lifetime ISA, but stocks and shares lifetime ISAs are available with Hargreaves Lansdown and AJ Bell. There's much more choice out there if you just wanted to open a stocks and shares ISA through all of the investment platforms already mentioned or elsewhere. And depending on what you choose to invest in, some investment platforms have no custody or platform fees. If we are now in agreement that investing is the best way to build long-term wealth, is there a simple method or strategy to help start us off on our journey? Well, one seemingly logical route might be to back the companies that are performing the best. For the past 7 years, that has been the Magnificent Seven. This is a group of high-performing and influential companies within the US who are part of the S&P 500 index of the top 500 US companies and who have been a significant driver in global growth. But just because they're performing well, does that mean that we should just invest solely in these companies and discount everything else? The chances are that if you do decide to do this, you will miss out on new growth companies of the future that we don't yet know about. Investing is unpredictable and nothing stays the same forever. And what is successful now won't necessarily be successful in the future. You only have to look at the top 10 companies in the S&P 500 in times gone by to see how that order changes in a significantly short space of time. And some well-known names of the past are now nowhere to be seen. To reduce making financial mistakes, and to minimise the work that you would constantly need to do in researching, keeping on top of performance, and buying and selling if invested in individual companies, a different, less strenuous approach might work for you better, and that is to invest in every single company. In the case of the S&P 500 index, that would mean investing in all 500 companies. And this is very easy to do by investing in a fund, normally in the form of an exchange-traded fund, ETF, or in a mutual fund. Both are very similar, and the differences are not worth worrying about or mentioning in this video. If the fund is passive, which is the easiest choice for amateur investors, it will be low cost and just track an index of companies such as the S&P 500. Whatever market returns that group of companies in the S&P 500 then collectively provide will be what that passive fund that tracks the index for you provides to you. And I've used the S&P 500 index for illustration purposes as it is the most popular and is tracked by many fund companies such as the Vanguard S&P 500 UCITS ETF or the iShares Core S&P 500 UCITS ETF. But this isn't the only index out there, and you can go much bigger if you want and purchase shares in a global fund that will track a global index such as the FTSE All World Index. And this will mean that you invest in the whole world. Investing in funds also provides you with a very special free risk management tool that you wouldn't get if you were investing in an individual company. And that tool is called diversity. If you were just invested in one company, you would be taking on a big risk, as lots of factors can and will influence how that company performs on a daily basis. And this will potentially give you a very volatile investing journey. Your capital is also at greater risk by investing this way, as if that company goes out of business, then you stand to lose all your money. But this is not the same if you're investing in funds. If that same company performs badly, then the other hundreds of companies within that index will help balance things out, and you would not lose all your money if that company went bust. The chances are that a single company, unless a mega cap such as Apple, Microsoft or Nvidia, would not even cause a ripple in the value of your portfolio. Funds can be purchased for your SIP, your stocks and shares ISA or your lifetime ISA. You can purchase mutual funds and ETFs with the likes of Hargreaves Lansdown, AJ Bell and Vanguard. But investment platforms such as Trading212 and Invest Engine don't charge any custody fees if you stick with ETFs. The only other significant charge that you'll encounter as an investor is the ongoing charge figure or total expense ratio. This is a fund charge rather than a platform charge for the fund's administration. If you choose a passive fund rather than an active one, you can keep your costs lower by just tracking an index rather than paying a fund manager more money to try and beat it. I don't want this video to go on forever, so I'm not going to try and cram anything else into it. But if you want some more information to help your research on what funds to invest in, then this video looks at potentially some of the best Vanguard funds, and this one looks at some of the best global funds. Thanks very much for watching.